This is Kyle with Fundamentals of Finance, back with my next video in my series about careers in the financial industry. I've already covered a comparison of the CFA versus MBA and an overview of the financial advisor job, and today I'll be introducing you to the world of investment banking. As with the other videos in this series, I'll be covering what investment bankers do, what their career progression looks like, how much money they make, and how you can break into the business. Back when I was a kid and I was playing Monopoly or watching old movies, I used to hear the term banker as if it was such a high up position. This clip from Shawshank Redemption comes to mind.
Some hotshot banker.
I remember thinking as a kid, do bank tellers really make that much? Well, one day I became a bank teller in college, and no, they don't. What I eventually learned is that rich bankers are not the tellers, the personal bankers, the loan officers, or anyone else you'll see when you walk into your local bank branch. Investment bankers are the quintessential Wall Street guys wearing pinstripe suits in their corner offices, making boatloads of money, and often carrying the egos to reflect that. Their actual job is really fascinating and more important than a lot of people realize. There are a few different areas within investment banking that I'll cover, but essentially they help large businesses and governments with their financing and investments. Somewhat similar to the things a regular commercial bank, like Bank of America, and a financial advisor would do for individuals. Where they're similar to a commercial bank, but for businesses and governments is in underwriting. If you want to get a home loan, you can just walk into a bank. You're small potatoes, and there are so many people in situations just like yours that the risk is easy to assess for them and the pricing is fairly standardized. When a company wants to raise money, it can get a lot more complicated. That's where investment bankers come in, with the expertise and connections to help get the deal done. Let's say a software company wants to raise $50 million to help pay for an expansion of their business. To do that, they can either issue bonds or sell a piece of their company to investors through an IPO, or initial public offering. But how much is that software company actually worth? How risky are they? How much should investors have to pay? Well, that's a lot harder to assess on a one-of-a-kind software company than it is for an individual. And how will the software company find investors to buy $50 million of bonds or stock in their company? They don't know how to find investors. They just make software. Investment bankers help make that deal happen. For an underwriting fee, they will use their expertise to advise the company on the best way to raise money and then use their connections to large investors to find buyers for the stocks or bonds that the company wants to issue. They usually buy some of what's being sold and sell it on to investors later at a profit. So they not only earn fees, but can also earn huge profits if the deal goes well. They can also lose a lot of money if they can't find buyers, the price goes down, and they're left holding the bag. That's why investment bankers are paid so much. It's a high-flying, high-stakes, high-risk job where you're routinely talking in the millions or billions of dollars. The other major functions they perform are more similar to what a financial advisor would do for an individual, but again, much more complex, and their clients are companies and governments. If you want to invest your money, some sort of combination of diversified mutual funds or ETFs is probably all you need. And your situation isn't that different from others a financial advisor has probably already seen. If a company wants to buy another company or merge with another company, that's a lot more complex. There aren't nearly as many investment options, there is no set price, and in most cases, the company you want to buy or merge with has to agree to the deal. No individual investor has to ask permission from a mutual fund before they buy it. Again, the investment bankers use their industry expertise and connections to make this deal happen and find terms that work for all parties. Investment banking doesn't have the best reputation outside of Wall Street because so few people really understand what they do. And their blunders, like their role in the great financial crisis of 2008, are often very high profile, but they actually serve an absolutely crucial function for a healthy economy. Companies and governments rarely have the expertise to find investors with such large sums of money, and investors rarely have the tools to evaluate a private company. Without them, it would be a lot harder for governments to borrow or businesses to expand, and a lot more investors would get screwed over. Investment bankers have that expertise. They're a neutral party in the middle. Many of them have strong reputations and have been around over 100 years. And they have some skin in the game, so they're often the best bet to secure a fair deal for all parties. Breaking into the business is really hard, with top investment banks like Goldman Sachs, JP Morgan, and Morgan Stanley often having an acceptance rate of less than 5% of people who apply. Typically, the best candidates would have gone to a top business school and had at least one internship in a related field. But before you decide to go down that path, you have to ask yourself if it's the life that you really want, because it's not easy. Yes, you can make a ton of money, but you really have to work for it. Right out of college, an entry-level analyst will usually make over $100,000. Not many other jobs will offer that, but they will also probably have to work 80 plus hours per week for the first few years. Lots of people burn out before they get to the higher levels, so in addition to being good with numbers, having strong attention to detail, and the right credentials to get in the door, they also have to be willing to commit to that life and sacrifice some of their 20s for a chance to make it big later on. If they decide not to stay, a few years in investment banking can often be a great stepping stone to becoming an analyst for an investment management company, which I'll be covering in my next video. But for those who do stay in investment banking, as they progress, they typically work less and make more. And managing directors often make well into the millions of dollars per year. To sum it up, investment bankers are probably one of the main things you think of when you think about stereotypical Wall Street. They're not exactly loved outside of the Wall Street community, and the job is poorly understood, but it's actually incredibly important for a healthy, well-functioning economy. Investment banking is very hard to get into and very demanding, but it's also very rewarding if you can make it. In the next video in this series, I'll be covering analyst and portfolio manager, which is a common career path for people who start off in investment banking, and probably the coolest job in this series, in my opinion. After that, the final video will be covering wholesaler, the $500,000 a year job you've never heard of, which by the way is a lot easier to get into and doesn't require you to have an Ivy League education or work 80 hours a week. So be sure to hit that subscribe button and stay tuned. And if you want to learn the 9 habits you need to be a successful investor, check out the link below in the description. Thank you for watching, and I will see you in the next video.